Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to the Deep Dive. Today we're taking on a pretty critical mission, really synthesizing the latest intel on U.S. middle market M&A and financing. We're looking at the first half of 2025.
Yeah, and we've pulled together data from, PitchBook, GF Data, Robert W. Baird, quite a bit to sift through.
Absolutely. And what we found is this market defined by, well, a really profound, almost counterintuitive tension.
That tension is really the core takeaway. I think that's why this deep dive is so essential for you listening in. H1 2025 was just dominated by this macroeconomic fog, right? Especially the uncertainty swirling around trade policy, tariffs, all that stuff. And that uncertainty, it really crushed deal volume.
Yeah.
But here's the puzzle. The prices that high-quality assets were commanding, they stayed stubbornly robust, very selective market.
Okay, so we need to understand who's paying that premium and why, especially when general activity is so muted.
Exactly. Let's unpack that.
Okay, let's start with the contraction itself, because that headline metric, it paints a picture of real caution, doesn't it?
It does.
We're looking at U.S. M&A deals under $500 million, the lower middle market, and that category saw a, 13% decline year over year? First half of 25.
13%. Yeah, that's not just a slowdown. It's a significant pullback.
So it signals this widespread wait-and-see approach you mentioned.
Totally. And these sources, they're pretty clear on the specific headwinds driving this. You've got, obviously, the broader macroeconomic instability, inflation still hitting consumer demand.
Right.
But the unique factor, really, for H1 2025 was that persistent uncertainty around tariffs, trade policy.
Can we just clarify that? Like, tariff uncertainty, it sounds a bit academic, but what does that actually do to a middle market deal? It must just kill confidence.
Oh, it's lethal to due diligence. CIBC actually noted a really distinct impact on activity right after those April tariff announcements came out.
Okay.
Think about it like this, from a buyer's viewpoint. A tariff isn't just a cost. It throws immense volatility into your supply chain forecasts.
Right, you can't plan.
Exactly. If a potential buyer can't reliably model their cost of goods sold for, the next 2 quarters because maybe a 25% tariff gets slapped on or taken off,
The whole model falls apart.
the whole valuation spreadsheet just collapses, basically. The risk premium becomes unmanageable. So what do? They pause the deal or walk away.
That makes perfect sense. Yeah, deals die when risk is just unquantifiable. But you mentioned not everything slowed down. There were these pockets of resilience, particularly in industrials.
That's the key takeaway when you look at the buyer profile. Buyers were actively, avoiding trade-exposed industries. Makes sense, right? Instead, they focus capital on assets tied to stable domestic infrastructure needs, stuff we call the built environment.
Okay, like what specifically?
We saw a definite preference for companies involved in, say, HVAC, data centers, essential concrete manufacturing, things like that. Stable domestic industrial manufacturers, essential service businesses.
Basically stuff insulated from those global supply chain shocks.
Precisely.
Okay, so that shift in volume, that gives us critical context. But the real structural story here seems to be how that contraction is hitting private equity, specifically their ability to actually exit investments.
Yeah, the lag in U.S. PE exit activity is creating this intense pressure cooker situation.
The Dave stuff.
The data on exits is challenging, yeah. PitchBook estimates show the PE exit count for Q2 25. It dropped nearly 25% compared to Q1.
Wow, 25% quarter over quarter.
And Q1 25 was actually the strongest exit quarter PE had seen in 3 years. So that Q2 dive really highlights how abrupt that chilling effect was from the policy uncertainty, those higher input costs.
So just slam the brakes on?
Pretty much. Exit metrics right across the board, they slip below the pre-pandemic averages.
And of course, when you can't exit, your assets just sit there getting older, which leads us to these elevated hold periods. We heard about that peak, 7 years in 2023.
That 7-year number was startling. And while the median holding period did decline slightly to 6 years through H1 2025, 6 years is still profoundly elevated.
Compared to what, historically?
Well, the historical average before 2020 was around 5.2 years.
So nearly a year longer on average.
Yeah. 6 years feels like an eternity if you're a limited partner, an LP, waiting for that liquidity event.
It's like watching your favorite TV show get renewed forever, but they never announce the final season.
Yeah.
So what does this prolonged hold, driven by all this volatility and policy mess, what does it do to a sponsor's ability to actually hit their return targets?
It puts immense pressure on them. Immense. They have to find alternative liquidity solutions. And this pressure, it's exactly why we're seeing this massive acceleration in using continuation vehicles, CVs.
Ah, okay.
That's arguably the defining financial trend of H1 2025.
So these assets are sitting on the books longer than planned. The pressure cooker needs a release valve. Is that why CVs are booming? Are they really the new PE liquidity release valve?
They absolutely are. I mean, CVs were relatively marginal before 2020. We were seeing, what, fewer than 40 per year?
Right, not many.
Then they just accelerated sharply, hit a record high, 127 CV-related exits in 2024.
Okay.
And what's fascinating now is that H1 2025 is actually tracking ahead of that record pace. 70 transactions already done in 6 months.
70 in 6 months. Wow. That suggests another record year is pretty likely then.
Highly likely. It's powerful evidence that sponsors are strategically embracing this structure.
Okay, but for listeners maybe less familiar, why this structure? What makes a CV the answer right now?
Well, it's not just some accounting trick. It's a pretty significant shift in, like, power dynamics and portfolio management. When traditional M&A is selling to a strategic buyer or another PE firm, when that's muted because of market uncertainty.
Like now.
Like now. CVs offer immediate liquidity for the LPs who need or want to cash out. But crucially, it lets the general partner, the GP, keep control of their best assets, often assets that aren't quite fully mature yet.
And keep collecting fees.
And keep collecting management fees, exactly, while still realizing gains for those exiting LPs. Lots of sponsors are even running dual processes now, meaning they prep for a normal auction and a CV at the same time. And if the auction doesn't hit their valuation hopes,
they just pivot to the CV.
They pivot to the CV. It lets them manage that aging inventory while maximizing their control. It's smart.
Yeah, that gives the GP huge leverage over the timeline. A smart defensive move, maybe, but still driven by that market failure and volume. Okay, but now we have to tackle the real paradox here. The thing that challenges this whole caution narrative, valuations are staying robust.
This is the critical piece.
Oof.
It demands attention, because it just underscores the intense, like, quality discipline in the market right now.
Yeah.
Despite that 13% drop in overall deal volume.
Yeah.
Valuations for the high-quality assets in the lower middle market, they did not soften. The average EBITDA multiple for LBOs between, say, $10 million and $500 million was 7.2x in H1 2025.
Okay, wait a minute, though. If volume dropped 13%, doesn't that mean 7.2x is maybe the price floor, but only for a tiny elite group of deals? Are we confusing robust with highly exclusive?
That's exactly the right question to ask. And yes, it is exclusive. That 7.2x figure, it stayed consistent with the full years of 2023 and 2024. And you're right, 7.2x is a significant premium over the long-term historical average.
Which was what again?
About 6.7x, running from 2003 through 2020.
Okay, so half a turn higher than the long-term average, even with volume down.
Exactly. So what this signals quite strongly is that buyers are still aggressively competing on price, but only for the truly defensible, resilient, A assets. The company's not getting hammered by tariff worries or inflation.
So the pool of targets shrank, making the competition for the best ones even fiercer.
That's it.
And presumably that demand is being fueled by excess debt. Lenders haven't slammed on the brakes entirely, despite the macro fog.
Correct. Lenders are showing sustained but very targeted confidence. Total debt multiples actually rose to 4.0x EBIT in H1 2025.
Which is also up from the historical average.
Also up. Historical average was 3.7x. So the environment is still favorable for leveraged deals, but the risk tolerance is highly segmented.
How segmented? You mentioned a difference between add-on deals and platform deals.
Yeah, the difference is striking. Really informative. Add-on transactions, where a PE firm bolts a smaller company onto an existing platform they already own.
Right.
Those achieved significantly higher leverage. averaged 4.4x total debt multiple.
Okay, 4.4x for add-ons and new platforms.
New platform deals were held much tighter, only 3.5x total debt multiple on average.
Okay. So the math for lenders is simple. A bolt-on is just inherently less risky. You're adding revenue onto a proven management team, existing infrastructure.
Exactly. They're penalizing the uncertainty that comes with a standalone platform deal, especially now.
So in this kind of market, lenders prioritize known quantities, right? Established cash flows, management teams they already know can scale.
Precisely. It reflects that flight to quality we talked about.
Yeah.
Not just in the asset itself, but in the existing governance structure around it.
Okay, let's pivot now to a sector deep dive. Business services seems like a prime hunting ground for PE, and it really encapsulates this tension we're seeing between falling volume and rising value.
It's the perfect case study, yeah? Business services volume down 13% year over year in H125. Mirrors the overall market. Why? Elevated rates and that scarcity of premium ready to sell assets we mentioned.
Okay, same volume drop, but valuations.
Valuations conversely actually rose, went up.
That is counterintuitive. What did the overall average EBITDA multiple climb to in business services?
It rose to 7.5x in H1 2025. That's notably up from the 7.2x we saw in 2023 and 2024.
All right, so buyers are paying that premium. Why? What are they looking for?
They're laser-focused on subsectors with scalable operating models, and this is crucial, stable, recurring cash flows.
The kind of essential services businesses just can't cut, even if things get tough.
Exactly that. Think HPC services, again, managed IT services, compliance outsourcing, digital workflow automation, that kind of thing.
Right.
These firms tend to have really sticky customer relationships. Plus, they're benefiting from that huge ongoing trend of outsourcing core business processes.
And often tech-enabled, which adds defensibility.
Often tech-enabled, yeah. Gives them a layer of defensibility, predictability, helps justify that 7.5x multiple.
And we're even seeing the public markets kind of validating this, right? Publicly traded facility and industrial services companies, business process outsourcing firms, they actually outperformed the S&P 500.
They did. Over the trailing 12 months ending June 30, 2025. That kind of outperformance gives M&A buyers confidence in the long-term growth story.
Makes sense.
And it's also driving PE attention into areas that maybe were traditionally seen as too fragmented or, too low-tech, like professional services, legal services.
Really, even law firms.
Yeah, there have been recent notable investments in accounting practices, even law firms. It just shows that hunger for recurring revenue streams and consolidation opportunities is really shifting the boundaries of what PE considers a target.
Okay, so let's bring this all back together then. For you, the listener, what's the single biggest headline defining the first half of 2025?
I'd say the biggest headline is the market's extreme discernment. Policy uncertainty, particularly around trade and tariffs. That was the main culprit, depressing overall transaction volume. But that uncertainty only served to intensify the competition for the truly quality, resilient assets that A-list. And that kept prices consistently high, well above historical averages.
So the market isn't collapsing, it's just being ruthlessly selective.
That's a great way to put it. Ruthlessly selective.
And that selective pressure explains the aging PE inventory and why they're leaning so heavily on continuation vehicles as a strategic tool now.
Yes. And looking ahead, this whole situation sets the stage for a potentially massive event. If we get clarity on trade policy, if macro conditions stabilize, even just modestly, industry observers are indicating we could see a significant pent-up wave of exits finally hitting the market.
Like a dam breaking.
Kind of. And that flood of volume, if it happens, could finally help reset those long-holding periods back closer to that pre-pandemic 5.2-year level.
Interesting. And it really suggests that focusing purely on those broad external macro headlines, generalized inflation reports, global trade war talk, it kind of misses the point.
It misses where the actual capital is flowing right now.
Which is towards high-quality, tech-enabled assets, recurring revenue streams.
Absolutely. Yeah. The decision for sponsors and for sellers has become incredibly tactical in this environment, which leads us to a final thought for you.
Yeah.
If you were selling a high-quality asset today, would you prioritize waiting indefinitely for trade policy clarity, hoping for a premium auction down the road? Or would you leverage a continuation vehicle now to lock in that current premiumization, ensure liquidity for your LPs, and keep control?
That's the strategic question defining middle market M&A right now. A fascinating tension indeed.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.